Welcome back everyone to Stag Industrial. Today we will be having a look through this industrial REIT traded on the New York Stock Exchange under the ticker symbol STAG. Hope you enjoy the episode. Let me know your thoughts in the comments afterwards and let's get right into it. Firstly, you'll have to Google Stag. Now, bringing it up will give you the definition of a male deer. We don't want that. Instead, if you put in NYSC and the wee two dots, Stag, that will bring you up their wee Google market page, if you like. It comes with everything from their ticker symbol, STAG, easy enough, where they're traded, New York Stock Exchange, and of course their current price. They are $34.74. They're down about 2% today as of the 22nd of June, day before my birthday. Funny enough, as I reboot this series, it was the first company that I did a video on this channel, and they pay monthly, so you know that is definitely a boost. Although there's more to a dividend than just the frequency of the payments. And currently, they boast a pretty decent yield of 4.13%, highs of about $37 and lows of $26.56. We can bring the chart out to the last 5 years. This is a completely free resource, and nearly every single stock in the world, you can find it on Google just by typing in the exchange, and you can compare them directly to other competitors if you so choose, by simply just going over to this wee page, selecting. You can compare them to Realty Income, for example, and it'll give you a wee side-by-side comparison, employees pay ratios, dividend yields, any of the metrics that you really want to see. Now, when it comes to looking into a stock, I'm just an average Joe, so I'm going to show you the process that I use when I'm looking into any company. Of course, none of this is investment advice. It's just me going through what I do. So they are a real estate investment trust focused on the acquisition and operation of industrial properties throughout the United States. Some of their biggest customers, of course, being the likes of Amazon and other large retailers. Now, by this type of property, Stag has developed an investment strategy that helps investors find a powerful balance. We'll look at their annual report later on in the video. Now, again, best place to start is, of course, their website. Or you could go to the wiki page, whichever one you want to go to. We'll then be following it up with Simply Wall Street and a few of the other websites I use for reference. Links are all in the description below if you need any of them. Let's get right into it. So first up is, of course, their website, Stag Industrial. From here, for any company, their corporate website, make sure it's the corporate and not just the standard website. It'll give you everything you need to know, from news, corporate responsibility, investor relations. I'll tell you the ones that I mainly focus on. So properties, I love to just have we browse through them. Investor relations, sometimes I go into, and of course I go into About Us. You want to learn about the company that you're investing in. Board of directors, some people go so far as to see who's in charge, what they were in charge of, how good they are of a manager. You know, did they just come from a company that completely went up or upside down, or you know, things like that. I don't go into such depth in a lot of things. I simply skim over an awful lot, go in depth where I want to. Is that a strategy? It's just the way I look at companies. So yeah, let's get into it. So enterprise value of about 8.7 billion. Now we will be comparing certain metrics when looking into companies. Pay ratios, which is price to earning ratio. We'll be looking at, of course, their dividend yield, some of the balance sheet, and we'll be looking at intrinsic value, which is a method, again, of calculating the worth of a company stock. They have currently 111.6 million square feet of property in 41 states in the US, with about 561 buildings. Right, okay. So from here, in the latest news, press releases, if any of that is interesting you, you can pick up annual reports, of course, where they will paint themselves in a pretty glowing light, investor presentations, and sustainability reports. Now, if you were to click onto the annual report, this is what you'll be presented with. A rather large document, 118 pages. Don't worry, we're not going to go through all of them. I just want to give you a quick wee overview. 99% of their properties are occupied, and we can see here that they spent about 467 million on acquisitions in 2022. And if you go further down, we letter to the shareholders from William R. Crooker, the CEO. And further on down, you can see some of the companies that they lease to. There's wee Coca-Cola one, for example. And yeah, this has an awesome amount of data for anyone to dive into. I mean, you can. There are videos on YouTube where people literally spend hours looking through things like this and annual reports and financials. Now, what do most normies do, like myself? Well, I would jump over to the likes of Simply Wall Street, a really awesome tool that I do pay for and I am affiliated with, just in terms of recommendations, nothing beyond that. It's not like I own or run anything to do with this, but what it provides you with is like a great overview of a lot of data that is collated really into a nice package. And it is free to use. You don't have to pay for it, of course. I think you get a few free per month you can view, and the refresh after a certain amount of time. So you don't have to pay for any of these tools if you don't want to. So and I'm always up for anyone that's trying to maximize the tools that you can use alongside free software such as this. Gives you a bit of overview. Now, one really good thing that they use here is their snowflake analysis, broken down into 5 key areas: the value of the stock, the future growth, the past performance, health of the balance sheet, and their dividend itself. Is it, a good, reliable dividend? Stag, of course, scoring 5 out of 6 for their dividend. It's a really good top industry dividend payer. Health, future value, all these things falter somewhat. There is a lot of headwinds coming towards this type of industry: property values, inflation, interest rates. There is a lot of things to factor, but of course, a lot of people just look straight away at their share price. The low of we've seen about 27 back there in October. Now, market cap, 6.4 billion. And we can go down and see a few of the good points. They pay a reliable dividend of 4.13%. It hasn't been cut in at least the last decade. That, of course, is a really good sign. However, their growth slowed somewhat in the last 6-7 years. So that's something we will be looking at. Earnings forecasted to decline in about 9.5% for the next 3 years. Interest payments are not well covered by earnings. Oof, that's not great to see. There are large one-off items in their financial results, just something to note. If it's amber, it's something to note. If it's red, it's not great. And obviously the wee star, that's a good thing. They're an established dividend payer with an imperfect balance sheet. Be sure to check out my older video on this and you can kind of see how it stacks up. Or unless, I don't think I used Simply Wall Street in the first video on this channel. Oops. Anyway, ignore that. Moving on, profit margins are 26%, which are lower than last year of 37.5%. For a REIT, they have to pay 90% of their profits back as dividends. That's why dividends of REITs are normally quite reliable, quite consistent. Well, I say quite reliable. They're usually reliable on some of the more established players. Relatively new REITs, do be careful. Certainly, if you're looking into any of them, do a good bit of research. On down, we can see a price, history, and performance. Again, a bit like the Google chart, we can bring it out. But unlike the Google chart, it gives you important key points from financials to dividend to management. I think you can actually turn them off. Yeah, you can turn off what ones you don't want to see. Management updates, I don't want to see any. Strategy, no. Financials, and you can click in and see a wee bit of an article. Some of these are computer generated. In fact, most of them are. So again, do be a little bit aware of things like that. In terms of recent news and updates, now I always do keep in the loop. When it comes to news in any stock, I always have a wee bit of an idea as to what's going on. Do I go super in depth with every company I own? Not really. Do I use this as a general, glance over every so often? Of course. If it's red, it's usually something worth looking at. Example, executive chairman of the board sold 113,000 worth of stock for a 6.4 billion valuation company. That depends. If a lot of people do it, it's definitely something to be concerned of. Amber again, a stable bet and growing e-commerce and onshoring and manufacturing. And then other ones are just random exercising options to buy stock and other things. When it goes to shareholder returns, we can have a look here in the last 7 days versus the last year, how it's been going against other industrial REITs as well as the US market in general. Of course, this Simply Wall Street covers UK companies as well, quite well. Price volatility for Stag, they're a wee bit lower than the industry average, and they're considered a pretty low price volatility. Again, they're considered still not averse from risk, that's without a doubt. About the company, founded in 2003, when my sister was born, 93 employees, a bit of a random fact for you there, and they're a REIT, well, we've seen that earlier. You can show more, it does give a massive amount of content if you want to read into it. That is certainly something you can do. Now, when it comes to their fundamentals, we can see here earnings 174.74 million and the revenue 671. Pay ratio. Now, what does that mean? It's a price to earnings ratio, typically used as an indicator from relative value between companies that are relatively mature and generally profitable. It indicates to potential investors how much they have to pay for each dollar of earnings generated by the company. It depends on the industry and how high or low you really want this number, so always keep that in mind. When it comes down to earnings and revenue, it gives you a nice wee overview here of their cost of revenue, other expenses, gross profit, earnings. They currently sit on an 80% gross profit margin, pretty good. Earnings per share is about nearly enough $1 for dollar. And net profit margin is 26%. Debt equity ratio 71%. Not the worst I've ever seen. Not the best by any stretch either. But every industry and every company is vastly different in all these metrics. Supermarkets, for example, it's a razor thin net profit margin. Debt to equity ratio for certain companies is massive or really, really low. So all these are factors to be considered. Last earnings report was March 31st, 2023. Next one is, if it's not in the next 6 months, it'll probably be again March 2024. All right. Well, this is new, beta. It gives you a breakdown. I love visual aids like this. You know, it goes into general administration, depreciation, non-operating expenses, others, and it gives you a nice wee breakdown. Cost of sales, 126 million. Even gives you a wee bit of an explanation into it. Well, there you go. They are updating this by the day. It's pretty useful in that regard. When it comes to yield, 4.1%, 66% payout ratio. That's not too bad. When it comes to their ex-dividend date, though, it's the 29th of June. Now, let me explain something about ex-dividend dates for anyone relatively new to dividend investing. It's not the date that you need to own the share. If you own the share on the 29th, you probably will not get you won't get the next dividend payment. You'll need to own the share the day before this date, so the 28th. So when you see an ex-dividend date, minus a day, and that's the day that you need to have a share by in order to be entitled to the next dividend. Now, obviously, you can change about because Stag is monthly, you can catch the boat quite often. Some companies only pay once a year or twice a year, and their price can fluctuate on the lead up, and they can fluctuate after the dividends paid, depending on multiple factors. So, again, things to consider. I can't give advice, but I would never ever recommend jumping into a company just for the dividend payment, one time. And there's so much more to invest in than just the dividend payment. There's so much involved. But yeah. And then the pay date's July 17th, 2023. So again, something to note. Valuation. Now, there is a whole load of sections. We could spend an hour on this website going through each metric. I'm going to give you the key ones that I usually have a wee scoot through. So here in key valuation metrics, again, pay ratio, you can have a look at earnings to market cap. We can even click this and go to forward pay, which is forecasted, of course. You can go price to sales ratio, price to book. Again, if you Google these terms, or even you can hover over them on the website, gives you a wee bit of a breakdown as to what they are. And everyone uses them a wee bit differently. and it can affect how someone even looks at a company if they see the PE ratio, compare them to competitors. That's the main thing that we're about to see here. Price to earnings ratio versus peers. Now, again, very important is to compare them to companies that are similar. If you don't know competitors, normally Simply Wall Street will give you a selection right away. Again, sometimes you will have to dig and do a wee bit of research to find maybe more suitable peers. Sometimes you don't get good peers at all. Peers being just other companies that are in the same industry. So I do recommend that you at least check some of the peers out in case they aren't the ones that you really want to compare to. You can even compare them to companies that aren't in the same industry if you so please. I mean, you could compare them technically to like Realty Income, residential REIT, but you can compare them in Stag side by side if that's something you want to do. I'm sure in certain cases that makes a lot of sense. Again, awful lot of information that you can find here, without a doubt. Again, then the next major metric I could go to is this right here. Now, this is the share price versus fair value. Fair value based on a discounted cash flow model. If you want to learn more about it, you can click into it. But feel free to pause if you want to read exactly into how this model works. It's to estimate intrinsic value, although there is another discounted cash flow model and intrinsic value are slightly different in how they're calculated. We'll have a look at that again later in the video on a website called Alpha Spread. Okay, now they're overvalued on this model by 1.6%. Now bear that in mind when we have a look at later on. A lot of people maybe want to snatch up an undervalued stock. Maybe a lot of people avoid one when they see it overvalued. Well, it's in the orange. It all depends. Certain portfolios, investing styles, it changes an awful lot. For me, it's something that I always look. It's this 1.6 section, share price and fair value, is something I always look at for any company I'm researching on Simply Wall Street. You can go into analyst targets as well, and that will eventually bring you into future growth. There are also these sections where you can find undervalued companies, potentially, note that word very keenly, potentially undervalued companies. There's sections at the end of each of them. Depending if it's a metric that you really care about, you can go deeper into it, and this is a tool you can use. Future growth, they don't score well out of this. It's 0 out of 6. Industrial REIT growth is actually 8%, whilst they are not forecasted to grow. Revenue, surprisingly, is forecasted to continue growing. Earnings, not so much. Again, there's a lot of factors, and you would need to go far deeper into why this may be the case. Economically, I would say an awful lot of this is probably interest rates, as I said, inflation. That will eat into earnings. Revenue, if it might continue to grow. Again, some people see this as a good long-term bet. Others might be hesitant to go near a company like that. Of course, you can throw in free cash flow, cash from operations. Depending on the company, it may make a good change or a bad change. If it's a metric that's important to you and you want to look into it, there you go. You've got the tools to do that. There's plenty of other stuff you can have a look here. Earnings per share growth forecast, future return on equity, or you can go down again onto the next section, past performance. They score 1 out of 6 here, and you can see some past performance updates and how they stack against the rest of the industry. You can see back in 2012, they weren't doing too well. Their earnings were actually in the red all the way up until 2016. Fortune seemed to have turned around for them, and operating expenses are kind of stable, but they are rising, which is to be expected. Earnings have exploded, if you've noticed, as well as revenue over the past 3 or 4 years. COVID probably playing a massive factor in that, certainly. They also have a large one-off gain of $51 million in the last 12 months, something to consider. Right. Again, plenty of other metrics, return on equity, return on assets. If that's something that you want to have a look into, well, now you see it on the screen. Maybe you've used up all of your free companies and you still want to have a look at Stag. Definitely a way to go, especially if you enjoy my commentary. If you do, let me know in the comments section, and be sure to subscribe if you want to see more videos like this. I'm always keen to hear your thoughts. Fourth is financial health. Again, 2 out of 6 on the criteria. Debt to equity ratio 71%. Debt 2.46 million. Debt is not necessarily a super scary thing for massive companies. However, it is something that you at least need to be aware of and see how a company is spending, or not spending, looking after their debt. Short term, 268 million versus 119 million. And long term, it's looking much better. 5.85 billion versus 2.57 billion in liabilities. Now, when it comes down to this chart, the red is their debt and the blue is their equity. I just always like to see the equity a wee bit above the debt. You don't want to see debt taken over, because that is a bad spiral for any company. When it comes to cash and equivalents, they have a bit on hand, 73 million as of March 2023. Now, these are 4 metrics I always love to just run my eye past. See their net debt to equity ratio, whether it's considered high, anything above 40%. I don't know if that takes into account the industry, but again, you can compare them directly to competitors if you want to get a better idea as to how this ratio compares. Are they reducing debt over the last 5 years? It seems to be steadily rising with them. It's not well covered by operating cash flow. It is covered, though, by about 15.7%. And interest payments, again, they're not covered, but they are covered. Or they're not well covered, but they are covered. 2.5 times coverage. Right. Balance sheet. Again, you can see physical assets and receivables, cash, and then their liabilities plus equity displayed over here. Alpha spread is another way of looking at the balance sheet if that's something you're interested in. If you want a healthy company, be sure to click on that button and you can have a look through it. Dividend, 5 out of 6. This is the king daddy of Stag and one of their best selling points. One thing about them, I think they're a dividend aristocrat, which means they've paid a consistent dividend for at least the last 25 years. I will double check that, but I'm 99% sure they're up there with the likes of Realty Income. At least for the last decade, they've been consistently growing their dividend per share, although as you can see, it has certainly slowed in the last 10 years, or in the last 5 or 6 years. Their dividend yield has decreased. Now, that is because over time, as the share price rises in a given stock, their dividend yield will slowly come down if it's not keeping pace with the dividend per share. Hope that made sense. It is forecast to continue growing, though, in the next few years. You can throw in the earnings per share if, again, that's a metric you want to have a look at. Okay. Dividend versus market, industry average 3% for industrial REITs. Of course, they are certainly beating that. They're not in the market top 25%, but they're definitely far ahead of the bottom 25%. Earnings payout to shareholders and their cash payout as ratios as well. And if you want strong dividend paying companies, again, that is another option you can click on. Management, now a relatively newer section to Simply Wall Street. Again, if this is something that you really want to look into, it's available. Bill Crooker is the current CEO, $3.2 million in total compensation. He's been in the job about 2.1 years, so middle of COVID he got put in. You can see average management tenure and average board tenure. And again, it goes into great depth for both the CEO. You can get a massive write-up on them. You can even go in and have a look at the entire leadership team of every role, executive VP, CEO, chairman. You should have a look at Tesla and you see the position that Elon Musk holds. I can't remember its exact one. It's a humorous one to say the least. And again, now an interesting one I always like to look into is ownership. Who are the major shareholders and have insiders been selling or buying? Now, we have seen that in the last 6 months, 2 individuals at least have sold almost $800,000 worth of shares. You can see who those individuals are. They have to declare that if they're on the board or if they're on the board or the leadership team. I think they do have to declare. And you can see what price they sold at. Now, again, why they sold, why they buy, these are things you can look into. Whether you'll find the answers or not, it's hard to say. Some just drop out of the company. Some are probably just wanting to pay for a really expensive house. Again, the reasons are massive here and there. So again, if you just see a massive sell-off from an awful lot of people and it's getting a wee bit scary looking, again, that's when this would flag up. But again, I wouldn't be too concerned about these 2 individuals selling. ownership breakdown, you can see individual insiders 0.2. So again, they don't have a massive stake. It's not like one family owns the majority of this company. General public 10.5%. Institutions, however, 89.3%. And of course, the top three are quite literally, you guessed it, Vanguard, BlackRock, State Street, with an overwhelming 30% between the three of them alone. You can see the current value, amount of shares and whatnot. Then you can go on down if there's any that really catch you out, or well, catch your eye. You can have a look into them. Sometimes quite useful. There's Legal & General's Investment Management Limited. They also are there at about 0.79%. All right. Key information and a few other things. You can see the employees. They only had 36 in 2012, and they've tripled to just over 90 or 93. You can see their headquarters, again, if that's something you want to know. And their listings across all stock exchanges. On the London Stock Exchange, like OL98, although you can't just buy them as Stag on most apps. And you can see the other ones that they're placed in. Right. Now, let's just jump back over to here. Just want to show you some of the properties. I kind of overlooked this a wee bit. But still, again, I love spending a lot of time on websites, company websites like this. You can see every state that they have a presence in. From here, we can get some featured properties. And I just want to have a quick glance. Sacramento in California, 147,000 square foot warehouse. In Lebanon and Indianapolis, I think that's the state. 558,000 square foot. And in Piedmont in South Carolina, 331,000 square feet. You can click in currently available properties. Yeah, let's get a warehouse. Come on, that's what we're doing now. Oh, it's going to take a while to load. There we go. And we can have a wee look. Again, sometimes it's just nice to see, is it in your back garden? Of course, majority of the audience here between the US and the UK. You can have a wee look on this map. I always love looking at the maps of companies just to see, especially mining firms. I love to see where all that is. Asset management, acquisitions, again, a bit about us. It's always good to click in just to have a wee bit of a research. Who are these people? Although, well, this is more so on the management side of things. I was hoping an about us, like a wee write-up. I guess I'm not getting that. I'm getting board of directors and a few other things. Okay, good enough for me. Right, let's skip on to our next website that I am going to suggest using if you want to have a wee look into Stag. Dividend Watch. Now, I do use this primarily as a portfolio tracker. It's very good for all US stocks and UK stocks as well. Stag Industrial, we can click in, and again, it can give you quite a lot of information. Every website displays it a little differently. Maybe there's one that you fancy a wee bit more than others. Maybe it's more visually appealing, gives you to the point what you need at that point. And again, it's all about the options, seeing what's out there and what resources you can use. And that's all I want to bring to you, is just to show you all the websites that I personally use, and if they can be of any use to you, then happy days. Down to dividend safety, again, you can look at stock volatility, payout. It does give a lot of the same metrics. Some websites are a wee bit more up to date than others, but between the three of them, I would always jump between them just to get a really good overview. And you can see here all their dividend payments, their latest dividends, and you can see the way they just slowly track upwards. It seems every 6 months they sort of up it by half a cent. Still growth though, isn't it? Okay, so again, there is of course the portfolio tracker on Dividend Watch, and I have a few of mine that I track here, and I use in the other one. Rightio, let's go on to the next bit, which is Alpha Spread. This website gives you intrinsic value. Again, if you want to know what it is, it does give you a nice wee breakdown here. You can read as much into it as you want. Essentially, it's a different method of the one that we've seen in Simply Wall Street, essentially. So it's given a base case of intrinsic value for Stag at $27.7, which is about 20% overvalued. We did see it at 1.6% overvalued back at Simply Wall Street. So again, something to note. Worst case, this is the worst case, it's 28%. So they would give it closer to $25. Best case, it's 7% undervalued, and they see it closer to 37. Again, I suppose the goal of most people is buying low, for any stock, whether you're selling higher, you want the dividend payment. Again, it is something to bear in mind, especially looking into this. Again, there's fundamental analyses on this, balance sheet compositions, efficiencies. There is an awful lot. Feel free to pause if you want to have a look at any of this. Again, it is a website that you can pay for, or there is, I think it's 3 companies per week for free you can have a look at before paying. So again, something to note. All links are in the description if you need them. And it wouldn't be a Thomas Greer video if I didn't show you Dividend Max, another completely free, you can't pay for it, but it is completely free to use anytime, no limits. This is Dividend Max, really useful tool. Say I wanted to buy 100 shares of Dividend Max here, or Dividend Max. You can't buy, their shares are not publicly traded on this website. Stag Industrial, I want 100 shares, right? What would I get in payments? It'll tell me. Previous payment, what I'll expect next. Again, you can change it to any company you want. If you want Rio Tinto, another mining firm, you can click that. That's funny enough where we're going in our next episode. You can see a few other details here. Just want to let everyone get a bit of education here. Dividend summary. So it tells you when it's going to go X, which is in the next 7 days. Again, X dividend dates, 30th of May that passed there. You would have needed the shares on the 29th of May. Again, they are US stocks, so time zones if you're banned from the UK. Again, something to factor in. Pay date is normally when it lands, although if you're using a brokerage, Trading 212, Free Trade or whatnot, some of them can be delayed by a couple of days, so don't panic if you don't see money land into your trading account. Declaration date's the date that basically they announce that they're paying it, what the amount will be. There's nothing usually hidden. You know, if bad news comes, it's normally in the declaration date. It's not the ex-dividend date 99% of the time. So again, something to bear in mind. They pay 12 times per year, so every month. Monthly paying dividends are rare in the UK. Quite common among REITs in the US, so that's another difference. One last thing, whilst we're on the topic of education, is on the Grow's website here. Not affiliated or anything, I just wanted to show you the difference between market value and intrinsic value. So obviously market value, shares worth $30 on the market, it's worth $30. The market can influence. Sometimes there's pumps, sometimes there's dumps, sometimes there's bad news, good news, and the market just kind of has it going up, going down, and it gives you a wee bit of an explanation. It's the current price that's traded on a stock exchange. For example, stock of the State of Bank of India at 432 rupees, I'm assuming, means its market value is that, and you'd have to shell out that amount to buy a single stock. Right, intrinsic value is the fundamental or the actual value of the stock, unlike the market value, which is readily available. Because intrinsic value is not easily available to the public, although with all the websites and resources I've showed you, you can find it out. Because it includes market analysis, financial statements, and projected cash flows. Intrinsic value can change depending on the future outlook of a company. So that is something that you always have to factor in. Stocks constantly change, the economy, the world constantly shifts. So you kind of need to be on top of it when you're looking into anything, especially with your own money. Whoa, jumped onto my YouTube channel there. Heading back to Simply Wall Street. We'll just chill here. But yes, this is my new layout. I want to go as deep into companies, deep into the financials. I want to teach as much as I can. Let me know your thoughts in this first video that I am back. If you're seeing this, there's probably a load more videos. We're going on to Rio Tinto next, a mining firm with a large dividend yield. Hope you've enjoyed. Thank you. Yes, I've got merch. I've got everything from t-shirts to hoodies to, heck, I've even got mugs. It's great. So, back with a bang. Hope you have enjoyed the content. Let me know your thoughts in the comments. I'll see you all in the next one. Thank you.